How to be investor ready with your finances. If you are a founder wanting to raise funds, doesn't matter if that's equity or debt, then you really need to make sure that your numbers are right. My name's Alysha Randall and I'm a fractional CFO for Fast Growth Consulting. And today I'm going to walk you through what it actually means to get your numbers or your finances investor ready. So how to avoid financial issues so that you don't turn investors off. So what does investor ready actually mean? So when we say investor ready, we don't mean fancy pitch decks or jargon. We simply mean that your numbers are accurate, that you can explain them, that they link to your actual business strategy, and that they stand up to scrutiny. So let's look at those in a bit more detail. So the first one is getting your numbers right. So starting with your internal numbers, what does that actually mean? So to start with, it's just something as simple as your finance system. So whether you're using Xero or QuickBooks or MYOB, whatever it is, you want to ensure that everything in there is up to date. So you don't have things that are being calculated outside the system, and the system is updated once a month, once a quarter, once a year even. So you want to make sure that your accounting system is accurate and it is up to date. The second thing you want to make sure is that it's clean, the bookkeeping is clean. And what I mean by that is that your bookkeeping or all of the numbers that are sitting within your accounting system are accurate. Usually the easiest way to work out whether something's accurate or not is that your cash or your bank is fully reconciled. So every single transaction that you see on your bank statement has been pulled into your accounting system and it is matched to something that either sits on your P&L or your balance sheet. That is the easiest way to know. So when you're having a look at all of the bank balances that are sitting in your accounting system, they're exactly the same as what you see on your statement in your bank account. That would be step one. There's lots of other things that need to be checked, such as your VAT returns or GST returns, the taxes that are owing, your employee payrolls, all those kind of things, they all need to be fully reconciled. So if there are balances in there or transactions in there that don't reconcile to something else, then you may have some problems because you are telling investors that you have certain results and these certain results need to be backed up and they need to be accurate. You don't want a situation where the numbers that you're telling them are different to what has actually happened. You just want one set version of the truth, one set of numbers that can be fully backed up. So this is a first step, because the next steps, such as building a financial model or explaining cash runway or anything like that, you can't really do that until you have a clean set of accounts. So looking at a messy set of accounts versus a clean set of accounts can sometimes mean the difference between whether you're going to be funded or not by an investor, particularly at that early stage. The next one is to build a reporting pack. So what's really important about that is you want to demonstrate that you have a organized and sophisticated finance function. So what I mean by that is that you have regular reporting. Yourself, particularly as a founder, understands what's going on with the business. You have visibility, financial visibility of what is going on. So your management accounts at an absolute minimum should include your profit and loss or income statement each month for 12 months. It should include a balance sheet, which is a snapshot in time, but ideally you have history there as well. And then a cash flow as well, historically and future, ideally for 12 months, but you may just want to start with at least the next 3 months in the future. So investors are really looking for consistency and visibility. They want to understand what is happening. They want to understand that you understand what is happening. And they also want to understand not just what's happening financially, but also they want to hear a story. So you do want to show that your finances are matching your story. So what I mean by story, as an example, here is a dummy management accounts pack that I pulled together. And ideally, you want to be talking about the correlation between what you're planning on doing with the business based on trends that you've already seen, and then how you're going to take that forward. So a perfect example here, in these management accounts, you've just got the current month and then the prior 2 months. And if you're saying that your product A is a subscription product, and because you are getting good traction, the churn is far below how many new subscribers you're getting, and you're seeing the upward trend over the last 3 months, and then your forecast would show this trend continuing, then you're able to talk about the story behind that. Why do you think people are loving your product so much? What is the potential for this? Getting the investors excited. But you can see how historical trends help you predict the future, but it's also not just from a financial point of view, you're actually talking about this from a product point of view and what you're trying to achieve. So you could do that with product A and product B, your plans, your vision for what's happening across the board here. Similarly, you could also talk about the fact that your gross margin is improving. The reasons for that is because you're implementing this efficiency, or you found that as you get bigger, the cost of sales reduces because of the volume bias, these kind of things. Similarly, with your selling and marketing expenses, you could explain that the reasons for efficiency or the plans for going forward. But you can see how you're using the numbers to tell the story, and therefore not only is it highlighting that you know what you're talking about, but actually it gives an element of trust to what you're trying to achieve. Because if you're saying that you're going to get a huge amount of growth, and you are already seeing a huge amount of growth, then you're just continuing the existing trends, and therefore your investors are more likely to not only trust your numbers, but also trust what you're trying to say to them about the business. So you want to learn about what your numbers are actually telling the investors. So here's what investors look at and what it tells them. Are there shrinking margins? So in the example that we just saw, we saw that the margins were actually improving. And I will say, unless you're in particular industries, you may not be seeing that right now. Cost of living is a real issue, macroeconomic factors are a real issue. And so a lot of businesses at the moment are seeing that the margins have been decreasing just because the increasing costs. So your pricing may be off. It may be that you're not charging enough, because as things increase, you may need to revisit the revenue that you're coming in. But also you need to be quite mindful of the costs that are coming in. So is there something that you can do about that? Do you need to revisit your suppliers? Do you need to revisit the way that you're doing things? Are there ways that you can make things more efficient or more automated to improve the costs? So investors will absolutely be looking at your gross and contribution margins. They're very, very important. And if they are reducing over time, which is why they want to see the history, they will be nervous that going forward your margins will continue to shrink, and therefore you won't be as profitable as you had originally thought. The next thing that they do look at is whether you have a high burn rate. So are you spending ahead of your revenue, or are you burning inefficiently? So thinking about this, it's also thinking about the stage that you are in your business and also what region you're in and also what industry you're in. So if you're in fintech, for example, you're quite new, your burn rate's going to be quite high because fintech is all about volume and you need to get to a certain size before you're going to see a profit. Also for high R&D businesses, especially in the science field, there may be a huge amount of costs in R&D for a couple of years before you can start selling any products. So there are some nuances here. However, with other businesses, if you can't get your burn rate down, which again is aligned with margins, then the investors may be nervous, particularly European investors. They've become quite nervous about loss-making businesses. But if you show that your burn rate isn't reducing over time, they may find that by investing in your business, you're just going to use up all of that capital to deal with your working capital, deal with your monthly costs. So you do need to really revisit that burn rate and your margins to make sure that they're heading in the right direction. The next one that I think about is revenue flatlining. So is the product proven and is there a growth problem? So as a step one at your early stage, the most important thing that you need to do as a founder is get product market fit. So, whether it's with a new product or whether it's with your first product, you must spend all of your time and energy on getting product market fit. As soon as you've got that, then you can start growing the business. It may mean small iterations. I worked with a particular founder who pivoted 3 times. They're a very experienced founder. This is not their first rodeo, and they knew that the level of growth they wanted, they were getting growth month on month, but it wasn't exciting. And for him, he needed much higher growth for the product to be really interesting. And so they pivoted a couple of times before they got true product market fit, and now they're just flying. So it's worth spending that time getting product market fit while you're still small, while you can pivot, while you can be quite nimble. And then once you've got it, then you can fly. So spend the time early doors to get product market fit before you start investing in growth. So with your forecast, you want to make sure that is aligned with your fundraise. So again, the forecast must match the story. So if you're talking about all the things that you want to do in your pitch deck, you need to make sure that all those things are included in your forecast. There is no point in having a forecast that says one thing and a pitch deck that says another. That'll be picked up very quickly with investors and they probably will walk away. So the other thing that you also want to make sure is that your forecast shows how you're going to spend the money. So if, for example, you're raising £2 million, then your forecast should show exactly what you're going to spend that money on. So the most common ones are team expansion, product development, customer acquisition, and an international launch. They're the 4. And so you want to be very clear as to why you want to raise this money. So too often founders might show, a shiny growth chart, but the forecast can be full of unrealistic sales or missing costs. So you want to make sure that it's all lined up. So if a deck says £2 million is going to give us 3x growth, then you want to make sure that the forecast is aligned to that. As you're forecasting, you also will need to do some scenario modeling or what if scenarios, for example. So the most common models that we generally work on with founders is your base case. So that is your expected case, the one that a lot of people probably work towards. You have your stretch case. This one has much more aggressive growth. Often the sales team are aware of the stretch case and that's what they are working towards. And then you have the downside. So if you have slower sales, longer sales cycles, particularly with enterprises, and then delays. So by having these 3 different scenarios, investors will trust you a bit more that you're not really naive and that you don't just have the one version budget that you're working towards, and you're not prepared for a stretch case or downside. It is worthwhile having both. What stretch case does is it's again that kind of excitement of how big could we really get. But also, I've seen the negatives when a company has grown faster than they ever expected, and they operationally weren't prepared for that. They didn't know how to deal with a higher volume. So by doing this exercise, you have already put your thinking hat on and you know how you're going to deal with a bigger company. The same can be true for the downside. You're thinking about, if there is a downside, what does the business look like? And you essentially have a plan for that downside scenario, and you can just put that into action. I will say that you don't really want to wait until you start raising before you look at your finances. So if you're raising in 6 months' time, you should really start preparing now. So you want to make sure that you spend the time checking that your numbers are right. We do due diligences for founders all the time for this specific purpose. You want to get into the rhythm of monthly reporting, building cash flow forecasts, making sure that your team is aligned. So all of these exercises is not just about preparing for a raise, but it's actually about running your business better. So if you leave it too late and scramble at the end, it will look like last minute fixes and the investors will spot it. So make sure that you become more sophisticated and more professional with your finance management so that you're ready for investors, but also you're getting the information that you need as a founder. So if you don't have a full-time CFO, that's fine. You don't need a full-time CFO at early stage to do this well. You just need someone to get your numbers cleaned up, to set up your reporting properly, potentially build a forecast tied to your strategy, and then also guide you through investor conversation. This is exactly what we do at Fast Growth Consulting. We work with founders who are 6 to 12 months out from a fundraise, and we just get them sorted. So if that's interesting to you, then click on the links below. So investor readiness is not about perfection, essentially. It's about being in control of your business and also being able to explain it confidently. You want your numbers to be in order. You want them simple and consistent. I would say consistency is really important. Investors always spot if there is inconsistencies. You want to tie your forecast to your pitch deck, to your growth plan. And if you want help, that's what we're here for. So click on the link below and we will reach out to you. Otherwise, we do have free founder guides that you can take a look at. And we also run workshops on how to prepare for a fundraise. We've actually got one next week, but we do them relatively regularly. So go to fastgrowthconsulting.com to find out when the next workshop is. Apart from that, thanks for watching. If you found this useful, then please do hit subscribe for more founder focused content, and I'll see you in the next video. Thanks.